I discussed this in great detail in the starter material, but let me just touch on it here real quick. One of the examples that I use is that it's sort of like if you're, let's say you're down 2 ticks in a day, and you're not seeing it, you know, um, but you don't want to finish the day down. You want to try and get even, right? Everybody wants to be even. So you sit there for 2 hours and you finally talk yourself into a trade and you lose 2 more ticks. And you're really annoyed because now you're not down 2, now you're down 4. But at that point you say, okay, fine, I'm done. So you turn off your screen. The problem is that you knew you should have turned off your screen before that next trade. So you gave away 2 ticks. Now, on the one hand, most people look at it and say, well, those 2 ticks, you know what, tomorrow I'll come back in and I can probably make all 4 of those ticks back in one trade. That's true, you know. And I mean, you don't just because you lost 2 ticks, you don't quit trading. I mean, it's recognizing that the action's bad. But that's 2 ticks that you gave away unnecessarily. You recognized the action was bad. You knew that it wasn't a good trade, and you made the trade anyway because you wanted to take a shot and gamble and try and get even. It's either, double or nothing, basically, type of situation. If you do that once a week, that's 8 ticks a month. And you multiply that by not even 12 months. Multiply it by, say, 8 months. Right? 8 months of normal trading. I mean, that's 64 ticks per contract that you give away by just making an error like that once a week. Yeah, you're going to have losing trades, but if the trade is warranted, that's fine. It'll all balance out. But really stupid trades, or what would have been for me, these trades up here, I mean, I know going into it, this is where I talk about finding your own strengths and weaknesses. I know going into that it's just not a good trade. It's too random for me. But I could have taken a shot, I mean, especially since I had people watching, I mean, it wouldn't have looked that bad. I could have taken a shot at 14 or 14.5, and it would not have worked, but everybody, watching would have been like, well, I mean, whatever, man. You tried to buy it. It didn't break highs, I mean, everybody thought it was going to break highs. I thought it was going to break highs. It's fine. Whatever. You took a shot. You lost 3 ticks. And so people might view it from that perspective, right? So it doesn't even really look like a bad trade. It's just a trade that didn't work. But I know it's a bad trade. In my own head, I know that the way the action is behaving, it could go either way, and it is the prime type of area where if people don't throw more money at it, I mean, it's going to pull back in, and I'm going to be hung, and I'm going to have to lose 3 or 4 ticks, right? So I know that. I don't fire for that very reason, and I save myself probably 4 ticks. That adds up. It adds up over the month, and it adds up over the year. So just always keep that in mind when you're thinking about taking a trade. Good trades are trades that should almost come without hesitation. You might be hesitating a little bit just on entry because you think you might get 1 tick better, but you want in the trade. They are not hard to identify. And they may not work, but you step in and you go, you know what, okay, it didn't work, but still, that wasn't a bad trade. There was a lot of volume against me. So you're going to be able to identify those trades, but it's the bad trades that kill you. I mean, 64 ticks, that's huge over the course of a year, especially if you're trading some size. Even on, like a 10 lot. I mean, that's just huge. All right, so here, this is a good question, actually, and it touches on that same topic, which I was just talking about. So the question is, what's wrong with wider stops and smaller size versus tight stops and larger size, i.e., if you're risking the same amount of money? So that's an excellent question. So let me explain, because there is an explanation for this, and this is where I'm going with this explanation. Stepping into a trade and randomly risking 5 ticks, there's no edge in that. There's zero edge in that type of a trade. We're not talking about, or I'm not, let's say I am not talking about you know, bringing up the S&P, for example. Look at the S&P, right? And bringing up a chart and then saying, okay, here we are. We're at 2050. What I'm going to do is I'm going to buy 2050s and then I'll blow out at 2040 if this goes all the way down to here. But you know what? Otherwise, I'll hang on and just see if it goes to 2060. It's a coin flip. There's no way to know one way or the other which way that's going because it's too far off, right? You know, what I'm showing you is not based on randomness or a coin flip. What I'm trying to show you are spots where 8 times out of 10 or more, you can call the direction accurately because you know that at certain prices, given a certain price action, it's going to trigger off orders. So you want to be in right before those orders are triggered, and when they're triggered, you instantly get paid 2, 3, 4 ticks. It's not random. That's the difference. So a lot of people would like to tell you that, you know, they can buy 2050s and they know based on their trend lines and their moving averages and their fib waves. And I'm not picking on you. I'm making a point. They would like to tell you that they can buy 2050s and they know that, you know, 3.5 times out of 5, it's going to go to 2060. So they'll come out ahead in the long run, but they're delusional. There's no way for you to know that. You forget about it. Nobody knows that. What we do know is that at certain areas and certain prices, there are programs and traders who are looking to trade those prices in a certain way. There are certain areas where you know if it breaks, people on the losing side are going to puke out. And if they puke, their puking is going to help sustain the move. And you'll be able to start identifying those spots. When you identify those spots, you improve your accuracy. When you improve your accuracy, you consistently make money without trying to risk, you know, 100 ticks to make 100 ticks, basically. Or whatever the mathematical formula is. I recently did a blog post, and it was about spoofing, right? So if you go to my website and you go to my blogs, the newest blog, or actually the newest blog is on sim trading, which is a different topic, but the next blog back is about spoofing. They had a trial for this guy that ran a company called Panther Energy. Some of you, may be familiar with this already. If you are, just bear with me. But basically, the guy was convicted of manipulating some energy markets. How did he do this? He did it with a program that would spoof, but they wouldn't spoof the inside. This is the whole point. It would spoof outside of the inside market. So if the market's trading 11.511, this program would place orders from 10 to like 8.5 that would build up the buy side. And then it would test an order to see like if it could get filled on the sell side. I think that's how it worked, basically. And if it did, it was indicating that, okay, those spoofs were creating buy side orders, and he would just go the other way, basically. And he would spoof it up, and then they would buy into him, and then he would pull all the orders, and the market would immediately, well, not immediately, but apparently it did it a lot because he made a lot of money. The market would then fall as those orders were pulled off. So it was false manipulation. It was bidding up the market so he could get short and then pulling those orders and the market would retrace. And all of this was taking place, for the most part, just programs trading against each other. And that's all it was. If you're a human, you know what a spoof is. You can't be fooled by a spoof. I mean, this is the amazing thing to me. And I put a link up on that blog. And it's written by a guy who's also written a lot of really great stuff, not just on Wall Street, but other stuff as well. He's actually a really excellent author. I've seen him on TV a few times. He gets it. He's a smart guy. But, if you're sitting here and you all of a sudden see this bid pump up to 4,000 at 10.5, I mean, it's not real. Almost guaranteed that 4,000 is going to drop off and pull back off to 1,800 or 1,500 or 1,300. It's not reliable. But when you have programs that are monitoring the amount of volume on both sides of the market, they're actually adjusting their trade parameters based on that information. It's silly. It's absolutely silly, but it's real, and it does drive movement. So they convicted this guy, but they only got him on like a few charges. And supposedly he had done it thousands of times, but they couldn't bring up thousands of charges. So they had to break it down to 4 or 5 charges where they could really demonstrate it without any question. So where am I going with this? Where I'm going with this is that, these programs and these HFTs that are comprising most of the volume and dictating most of the movement, they're reading the volume. So that's why you want to read the volume. That's why I read the volume, because I know that there are programs that are going to react to a certain price holding. I know there are programs that are going to react to a certain price backticking, right? I know that's going to happen. So when I see that happening, I try to get in front of that program. And then those programs and, other discretionary traders, they react as well, and their reaction is what pays me. But in order to pick those spots, you have to wait for the spot. I mean, to just buy 14s, for example, and risk 8 ticks to the downside in an attempt to make 8 ticks on the upside, there's just no edge there. I mean, I don't know. I know that there's going to be people going back and forth at all these prices. I have no idea where most of the size is going to be. There's no kind of trigger that I know everybody's probably going to go one way, at least temporarily. There's just no trigger there. It's just random, basically. Even though the pressure's to the upside. And you see it confirmed. If you had bought any price between 13 and 15.5, you would have been hung. You'd still be hung. Because there's not an edge. It's just random. So as you work through the starter material and the starter videos and you see those trades, and you even see some of the trades that didn't work out, and the ones I tell you that are stupid, you can clearly see why they were stupid. Like my video stepping in front of a train. It was just, me being an idiot. I mean, that's all it was, really. It was me trying to force trades with people watching. But you'll begin to see why certain trades offer you an edge, and they work more than half the time. So that's why I focus on that type of a style. Question: do I ever leave an order on so I can have a better position in the queue in case of a retracement? No, not for retracements. I mean, I'll leave the order on. The reason that one order I placed, I canceled it, was because I knew I wasn't going to get it. So like in that area, if I had placed an order and it snapped to 10 and then I thought I could get 10 halves, I would obviously have left the order there. But once it broke to 9.5 or 9, I don't let it stay out there, mainly because, like I said, it's not as reliable the second go around sometimes. It depends on the context and the day and what we're looking at. But there are some times when you can play the same spot 2 or 3 times, and there are some times when that spot's only meant to be played 1 time. So I always cancel my orders. I don't leave them out there. You're liable to, like I said, you might get caught in a some kind of weird sweep. Question: do I recommend trading the treasuries overnight? I do not. Like I said, about the earliest you want to start trading treasuries would be maybe 7:30. You're going to find that you're taking a chance overnight because the volume is pretty light typically. I mean, if you want to try it, you can try it, but you're going to notice a substantial difference in how the action behaves between 11 p.m. and 6 a.m. versus how it behaves from 8 a.m. till noon. Very different and not very reliable. Question: do I trade the opening of the treasuries? So in other words, like they do in stock trades. No, that's kind of a myth. It's, or not a myth, but it's just, again, I don't find it very reliable. It's like people, the whole idea of trading the gap open. I've seen so many studies with people saying, the gap closes, it tends to close, whatever. It just depends on what happens right out of the gate. I mean, and if you're watching the volume, you can usually see. So even if it gaps open, trying to fade that move, thinking it's going to close the gap or close half the gap or something to that effect, it's pretty random. You need some confirmation from the order flow before you take a trade like that. So yeah, I mean, I'm here for the open always, and I obviously do want to trade it if the action's good, but it's not. I don't obligate myself to trade the open. And of course, you always want to be here for 8:30 because a lot of the news data does come out at the 8:30 numbers come out at 8:30. Duh, no. You want to be there at 8:30 because a lot of news reports are released at that time. Question: for the beginner, do I recommend you start trading on the 10-year? Yes, I do. I think I discussed that yesterday. But for now, I would definitely say stay with the 10-year. It's more liquid. It's easier for you to get in and out. You won't get as beat up as you would probably trying to trade the 30-year. You'll get better fills. There'll be times when you can work the bid in the 10-year and you'll get it, but if you were working the bid in the 30-year, you would not get it. So for now, for the first few months at least, definitely stick with the 10-year. And that's all I've been trading for a while now. I don't even trade the 30 right now because it's been so thin. Sometimes there's only 80 or 100 contracts on each side. So I like to be able to hit out when I want out. Someone was talking about the shakeout, which, as it turns out, was not a shakeout. It was just a way to work people over on both sides. But what a shakeout is this. I'll show you. I can't think of any video samples that come to mind at the moment, but I'm sure I have some. A shakeout would be the market gets near the high. And so naturally, let's say the 30-year is approaching 6, 7, 8, 9, right? As it starts approaching those levels, you're going to induce buying from people who want to be long if it cracks the highs. So buyers come into the market. However, if there aren't a lot of buyers, then what often can happen is maybe you have some guys that want to buy, but it's like a head fake. So what actually happens is they begin offering a little bit of size up here. They notice that they're not getting run over. So they're also working the bids underneath. So you have some guys that are working bids at like 5, 6, 7, whatever, and then they sell a little bit at 9, 8, and then they pull their bids away. And so naturally, these guys who are trying to buy up here, they start scratching their trades and getting out. Because it's like, is it going to go? No, I'm out. Is it going to go? No, I'm out. And they do it like 2 or 3 times sometimes, and the market falls back in. And so it's called a shakeout because the action shakes out people who are net long. And then what happens is when all those guys are kind of shaken out, they've already been shaken out of the trade, they don't want to try it again because it failed the first 2 times. Now you have a wave of the buyers that were pulling their bids. They don't pull their bids anymore. They not only ramp up their bids, but they also start lifting offers, and they run the high. So as they run the high, now all these people who were net long are upset because they missed. They're missing the trade. And then they often try jumping on board right there at the high. Well, as they're jumping on board to try to run, to not miss the move, the guys who were pulling their bids and then bid it up are already working their outs above the high. If you watch my second video, the fact versus theory, I give an example of how a buddy of mine and I did that back when I could trade size for a firm. And that's exactly how it works. You're basically, we weren't shaking people out, but people were basically getting shaken out at a point. And then as you run a high, you're already working offers above it. So you're instantly getting filled as the stop orders are being triggered off. Question. So the volume profile column shows the overnight high and low. Is the pit opening price significant? It can be. It can be. You want to have some idea of the general area. More for if the market gets back to that price again. So, for example, if the pit open is at 10.5 and the market instantly starts trading down and goes all the way to 5.5, 4, 3, whatever. If it gets all the way back to 10.5, that may play a role again. But really, people pay less attention to the opening price or the VWAP than they do to like that step in the profile. There were more people paying attention to the fact that the market was pressing back to 8 and 8.5 than there were interested in the fact that it was maybe pressing back to like say 10 or 11. The steps in the profile usually play more of a role in terms of where people, I've noticed anyway, where heavier volume will come into play. Sometimes it works out perfectly, like you're seeing. I mean, you have heavy volume right at the VWAP or whatever, but only in the 10-year. You see the other markets are off. So yeah, the pit open can sometimes play a role, but it's not real significant. But yeah, you can mentally keep track of where it is. Just each morning when you watch it open, you just pay attention. 2 questions. They go hand in hand. Do I mostly exit on a 2 or 3 tick profit, or do I have a trailing stop method? And as a follow-up, do I have a hard 2 to 3 tick stop loss? Do I enter resting stop orders? So I'm generally, when I go to take a trade, I do try to identify trades that I think have potential to at least get 3 ticks out of them. But you can't always do that. So more of what I'm looking for is getting the right price that doesn't instantly go against me. And then I sort of manage it based on that. Now I know, for example, like I said in that earlier trade, if I had hit 10s or 9.5s on that short, I know as soon as I enter that trade's only good to 8.5 or 8. Best case scenario, probably. So yeah, before I even get in the trade, I know that I'm only looking to take 1 to 3 or 4 ticks out of the trade. It just depends on how it behaves. And yes, in that scenario, I'm not risking more than probably 2 ticks on that trade. So I would have a hard stop in that scenario with a projected profit of hopefully 2 to 4 ticks. In other scenarios, like for example breaking lows or highs, it's not even a hard 2 or 3 tick stop. Usually it's I hit the price and it should go in my favor instantly. And I discussed this in the putting it all together video, the starter video. If I hit a price where I think it should be snapping and it doesn't snap, I often just scratch the trade right away. It's my way. In my mind, I make a completely risk-free trade. I'm able to hit a price. I know I'm going to get a free look for at least a couple seconds. And if I don't get paid and I can see it doesn't look like I'm going to get paid, then I just scratch the trade. And I literally risk nothing to make something on a trade like that. So that's how I manage that. And then there's the occasional trade, like I was discussing today, where maybe you think it's a shakeout type action. Maybe I do get long 10 halves, 11s, 11 halves. And now I am looking for the market to go back to 14 or 14 half. And if it does, I'd use a trailing stop in that scenario. So let's say I got long at 11. Again, this is just, we'll see actual live trades of this, but we're doing a Q&A today, so I'm just trying to explain. I get long at 11. The market presses up to 14. At that juncture now, I'm hoping they break highs. I want to give it room to break highs, but worst case, I'll lock in like 12 halves. I don't really like just taking 3 ticks out of that trade when I could take 6 ticks. But at 14, if it goes high, at that point, if I allow it to go from 14 back to 12 half, I'm only risking 3 ticks of my profit. On the upside, if it breaks highs, I'm going to make another 6, 8, 10 ticks in that trade. I mean, it's just rare that those come along, but when they do come along, you get paid. So that's the way that you can manage a trade like that with using a trailing stop, So hopefully that's an example of 3 different types of trade management and how they're applied in a different scenario. It always comes down to the context and the anticipation. Is this going to be a bounce trade that's only going to be good for 2 or 3 ticks? Is this going to be a break trade that I'm going to try to get a free look on? Is this going to be a 1-tick scalp because the market's dead and I can just work the bid ask a few times? Or is this going to be a trade that has real potential to run and I'm going to give it a little bit more room and I'm going to use a trailing stop? They're all different types of trades which require different types of trade management. How did I overcome boredom of the order book versus charts? Well, I find charts to be just as boring as the order book. I try to visualize what the players, the comment is, I try to visualize what the players are doing by looking at all numbers, but it gets so mentally intensive, I get tired. Do you have any advice on this? Yeah. You suck it up. That sounds kind of harsh, I'm trying to be humorous and add some lightness to the day since I've been talking and not trading. The days like this always bum me out because it just sucks to sit here all day and not be able to read at the market during a webinar, particularly. But the reason I make that comment is this is a business. And that kind of goes to that document I sent out to everybody. It's an addition. I just wrote that document prior to this webinar. And it's now the first part that, of, it's read me, number 1, read me, and the documentation. This is a business, and you're doing this to make money. And the way that you make money is by making highly educated guesses, keeping your risk in check, and managing your trades properly. It's not meant to be fun, and it's far from it. I mean, this is about one of the least fun things you could possibly do. I would much rather be, doing something else besides trading. I mean, it's just not a very fun thing to do. But, it pays well. It can allow you to escape the rat race, so to speak, and that's why everybody is here. I mean, that's what you're trying to learn. You're trying to learn how to make money. How do I make money from my computer, from my home, and not have to answer to anybody ever again? That's why you're here. That's how you maintain discipline. You maintain your discipline by remembering, if I mess up with this, I have to go get a real job, and real jobs suck. So I need to be disciplined. I need to be cautious. I need to practice. I need to study, and I need to treat this like it's a business. If you put $50,000 into a franchise, you open up a coffee shop or a restaurant or something. I mean, you'd be hustling every day. You would be making sure your recipes were right. Not too much salt, not too little salt. You would be putting so much effort into it, and unfortunately, so many people get into trading. And they treat it as kind of, pardon the phrase, but they half-ass it, basically. They treat it like it's not what it could be. And it is hard, and it's not easy, and it doesn't come overnight, and it takes a while to get a hang of this. But, I have some guys, you have to understand, there are a couple people here that they just got the starter videos last month. A few people, got it around Christmas or right around the beginning of January. And, a couple of them wrote me last week and they're like, did awesome last week. This is great, man. The stuff just in the starter videos alone You showed me how to, stuff like today, you know, I'm learning how to stay out of bad trades. And it saved me 6 ticks here and 3 ticks there. And so I finished my week up, you know, 15, 18 ticks instead of flat, or up 3 ticks, or down, you know, 5 ticks. I mean, it can be done. You know, it goes in waves. And it's hard because a lot of people don't have big bankrolls, so they're not trading for very much money in the beginning. But learning this can literally change your life. It can. I'm not the answer to your prayers or something like that. I'm not saying like I'm the Holy Grail. But what's in this material can help you a lot. And if you will maintain the discipline and the focus and work at this, you can literally change your life. And so every morning when you wake up, that's what you have to remember. And every time you're thinking about firing off a trade, that's what you have to remember. Don't let it freeze you. You know, don't get so analytical that you don't trade at all. But just maintain that discipline and treat it like it's a real business. You know, because you can make a lot of money doing it. I wasn't picking on you either, by the way. Lots of people always ask me that question, you know. And that's why I mentioned, you know, there's a kid that, you know, came to me a couple years ago. I call him a kid. He's a man, but he's only 22, so he's a kid to me. He came in like most people. If you've heard the video, you know, it's the interview with the No BS student, you know, and he's not the only guy that I've taught who makes money. Other people make money too, but I used him because he just, it made for a good interview, and I knew that he had been through the usual ringer, but he also, you know, he really had the dedication, and that's what it takes. I think that's probably why I showed him in the video, is because I know that he put in the time and the effort, and he worked at it a lot. And now he's 22 years old, and he doesn't work for anybody, you know, and he's on the path to never having to work for somebody again at 22 years old. So, and he's had some blow up days, you know, probably really only one bad blow up day. He learned a severe, you know, he learned a severe lesson from it, but you learn, and you know, he got past it, and he tightened up his discipline, and he hasn't done it since. Because he knows he doesn't want to go work for somebody else. I guess I'm rambling. Anyway, that's how you get over it. Because yes, it can be seriously boring. What is my risk to reward? You know, looking for, is it based on context? Again, yes, that's based on context. I always try to keep it at least 1-to-1. You know, so I'm not going to risk 4 ticks to try to scalp out 1 tick, obviously. But typically when I enter trades, I'm trying to pick a spot where I don't think it should move against me more than 2 ticks. If it's going 3, I know I'm too early or something's wrong. So I'm always in the situation where I'm probably, you know, minimum risking 2 to make 2. That's the ideal scenario. Sometimes risking 2 or 3 to make 3 or 4. So I'm always in the 1-to-1, 1.5-to-1 range, and then, you know, but you occasionally get the bigger winners where I'm risking 2 ticks and I catch the reversal to the tick. You know, I never have to take any heat and the market reverses and I make 7, 8 ticks in the trade. And those really help you out over the course of the year. They really balance things out. Whereas I never take a 7 or 8 tick loser, right? So I don't have lots of 7, 8, 10 tick winners, but I have a few. I never have a 8 or 10 tick loss. So it's always keeping that risk to reward comparable and then having the occasional nice winner, and that's how it balances out and the averages over the course of the year. So somebody wrote, simming ruins us and makes us gamblers. Yeah, for what it's worth, if you haven't read that blog on sim trading, please read it. And please get off the sim as fast as possible. I don't think we even discussed that in the interview, but it's funny. I was talking to Matt, the guy in the interview, a couple weeks ago, because he read the blog, and he said, "Yeah, man," he says, "You saved me probably at least 4 months that I would have been still trying to sim trade, and you told me to get off the sim, and I definitely learned, you know, more in 3 weeks of live trading than I would have learned in 6 months in the simulator." That's true across the board. Sim trading is so bad for you. It's good to learn your platform, you know. You definitely don't want to make mousing errors. You want to know what you're looking at and how to cancel and place orders. But once you're very familiar with your platform, start trading a one lot. Just do it. Don't even think about it. Open the account, little amount of money, and trade a one lot, and you will learn so much faster. What are the best strategies to trade sideways markets? A market like this is, in my mind, pretty untradeable. However, there are days where the market is sideways, and you can play the range really well. So, like, this range is way too wide, and it's not really been at the edges of the ranges. It's not been between 8 and, let's say, like 14. First off, that's too big of a range, but secondly, it's been more in the middle. But there will be some days when you can find a nice range, and like it kind of holds between 8 and 10.5, and you can actually play that range 3 or 4 or 5 times over the course of the day. And then, the one time it goes through you, you've already made up enough money to make up for that loss. As soon as it goes through you, you obviously have to stop playing the range. But that's really the only way to play a sideways market. Because if you try to play the middle of the range and then you start trying to average in, like say at the bottom, you're inevitably going to get caught. It's going to go through you, and you're going to try to average in a third time, thinking it's going to come back into the range, and it's not. And you're going to get hammered as it just continues to move in one direction. So the best way to play a sideways action is to try to identify, and you have to identify it fairly quickly, 2 prices that are holding very well on each side. And then you try to maybe make that scalp 2 or 3 times and see if you can't scalp out maybe 2 or 3 ticks, and then scalp out 2 or 3 ticks again, then 2 or 3 ticks again. Now maybe you're up 6, 7, 8, 9 ticks, and then when it finally goes through you, maybe you lose 2 or 3, but you're still net positive on the day. Question: even if the treasuries are dead, will I not see if the ES is moving and maybe it will pay my day? No, I don't. Because if the ES was that great of a trade, I would trade it outright. It's just not. And if you want to trade it, that's your prerogative. I'm not saying don't trade it. And certainly a lot of the stuff that I teach is helpful in the ES as well. But we'll bring it up and look at it. It's not the same. Here's what I say about the S&P and the NASDAQ and the Dow. So maybe this will help you understand. First rule of thumb. Most likely, most of the people in here, that was their introduction to markets, was stocks or some form of stock trading or stock futures. Most courses out there are about trading the S&P. If it was that great of a product, a lot more people would be rich. I mean, that's just the reality of the situation. The problem with stocks is that everybody trades them. Everybody. Grandmothers trade the stock market. You have 1 million HFT programs. You have thousands of firms, or at least hundreds of firms. And you have the S&P being traded against other stuff. So the S&P is being traded against baskets of the underlying stock. It's being traded against the SPY. It's being traded against other indexes. People do spreads between the S&P and the FTSE and the Russell. They sometimes are trading one off the other in terms of the European markets. They're making calls based on oil and gold and trading the S&P, right? So you have all these strategies being executed and at just blazing fast speeds. And while it can be sometimes very technical, there's no doubt about that. The S&P is known to stop to the tick sometimes in terms of support and resistance. You almost never get a trade with instant edge. Like, it's just really hard sometimes to make a call and say, you know what, I can take this trade and I'm going to get a free look, and if it doesn't go, I'm going to scratch it. I mean, it's just almost impossible. It's you usually have to give the S&P at least 3 or 4 ticks, if not more, unless you're on a one-way street, you know. But that's not usually the case. I mean, if we look at a chart of the ES today, I mean, here's a chart of the ES today. It did stop perfectly right here. That's no surprise. But look at that run leading up to that. I mean, that's a 10-minute run straight up. Do you really want to place a sell order at 57.50 when the market's just rallied from 52.50 to 57.50? You know, the edges are just not there to be had as easily as in the Treasury. So why is that? Well, because the Treasuries are not traded by as many people. They're heavily dominated by guys on fixed income desks, guys at Goldman Sachs, and guys who trade for the government and the Federal Reserve. So if you can learn how those big players tend to operate, you can be fairly certain that they do the same things over and over again on a daily basis, and you can learn how to take advantage of that. With the S&P, you're not just fighting bigger players like big traders or Goldman Sachs. You're fighting thousands of programs, you know, that are executing trades for whatever reason. Everybody's trying to front run everybody else. And yeah, some days, you know, you look at the S&P and it's like, yeah, this moving, you know, maybe I should jump on this train and try and scalp a few ticks. But on a day-to-day basis, it's typically just not a very good trade, in my opinion. I suggest trade over the S&P. I would suggest trading the currencies or corn or the Eurex products. Eurex products would be first, really. The Bund, the Bobble, and the Euro stocks would be my next choice. And then probably corn and maybe the currencies if you're going to go that route. But the commissions are very high for those, so you're going to get eat up with commissions. But those markets are easier to trade than the S&P. I mean, I've traded corn in the past. It's way easier to trade than the S&P. So is the Bund, the Bobble. To me, anyway. Maybe that's because of my scalping background and my scalping, mindset. But I just don't think the S&P offers consistent results. And I'll let you in on a secret. I've never met a profitable S&P trader who only trades the S&P. I know some guys that, traded back and forth, but usually, I won't say that 100% because I know there's some guys out there who say, they trade the S&P and they do all right, supposedly, or whatever. But like in my own personal life, like guys I know in Chicago, no one traded the S&P. Everybody traded treasuries or the corn market or European products. Question, is corn very illiquid? Corn's not, it's not nearly as liquid as the S&P or the treasuries, but it's liquid enough at times. The problem with corn is that you are subject to limit moves, which is horrendous if you're caught on the wrong side of a limit move. You can usually avoid that because you're not involved on days when you're anywhere near being at the limit. But the volume's okay. I don't go over there now. You stick with the treasuries for the time being. You'll be surprised. I've made a lot of converts. Please comment on the 30-year pressing the lows while the 10 and 5 are staying closer to the VWAP. So this goes back to what I was talking about yesterday. If you will watch the spreading video, that's what you're seeing here. The 30-year, your longer-term products today are diverging now to the downside, while your shorter-term products are maintaining in the middle of their ranges. And that's a product of the spread. So what that means is you have buyers working buy orders in the 10-year and the 5-year while simultaneously working sell orders in the 30-year. And that's blowing out the spread somewhat. It's making it get wider. They do that either to possibly, like at this time of day, is probably more to bring in trades. So What you probably had was earlier in the day, particularly because the 30-year was making the run at the highs. What you probably had was you had spread traders buying the 30-year as it was moving towards the high and selling the 10 and the 5. You know, that could easily be why we saw so much size trading there at 25 in the 5-year. So you have someone who's buying the 30, selling the 5. The markets adjust, they come back in. Now a person has to unwind that position. And because the volume is lighter in the 30-year, once they start selling the 30-year, the 30-year kind of falls off a little bit more. So as they're unwinding positions, they begin to sell the 30 and buy the 5, and buy the 10. And you see the divergence. But it's not really a clue as to something happening now because it's almost 1 p.m. in the afternoon. It's more of, most likely, like I said, people are unwinding their positions for the day. So when you see that type of stuff happening, again, I discussed this in the spread video, that's usually an indication you don't want to be involved at all. And that doesn't happen to have to happen at 1 p.m. That could happen at 10 a.m., or 11 a.m. or something. The spreading can pick up like that, and they can start diverging. So when they're diverging, there's really not much of an edge there because, unfortunately, all three products will not be moving in the same direction. So you think the 30-year is moving for lows, and the other market should follow, and you try to go short, but you try to go short the 10-year, and then they end up buying the 10-year up 2 ticks, and it doesn't really go anywhere. They buy the 10-year up 2 ticks, the 30-year breaks 2 ticks, and then it just chops around again, and you basically end up either making or losing a tick usually, or scratching or something like that. There's not really an edge or a good read to be made.